Hi, everybody. Welcome to week three, financial management. We're getting through this stuff. We have 8 modules, so we're humming along. This week, we kind of start to apply a little bit some of the concepts that we did before. Financial ratios are at the forefront of a lot of the stuff that we do because here, there's sort of like, why do we do all the ratios? Understand the past. This week we start talking about forecasting and the idea of I look in the rear view mirror and I say, okay, how have things gone in the past at a macro level for the whole company, or maybe could be just one division? How have things gone in the past? The activity levels, the leverage ratios, everything. And then I turn around and say, okay, what's it going to be for the next month, the next 3 months, the next 6 months, the next year? Some of this module will tie to budgeting going forward. Some of you may be involved in budgeting. Hopefully in the next couple of years for your financial careers, the old way of budgeting will change. It's very laborious, sometimes meaningless exercise when you go out 5, 6, 7 years, kind of pointless, but it does enable you to look at your organization and start to pay attention about what the bells and whistles are that drives cash flow, drives value of your firm. So forecasting itself is the idea that we're gonna look at the past, like I said, what our sales were, for example, at the top line. And generally, that's where we start, right? We say we think we're going to get this amount of sales. And then the sales, everything related to the sales in the income statement is tied to each other. Again, gross margin is tied to what it was in the past, right? That tells me what my cost of goods sold are going to be. I can look at my past operating margin. I can look at my past debt ratios. I can go right down the line for my income statement and build a forecast year by year by year or quarter by quarter, whatever it makes sense. This is really important to do for all of us. You have a project at the end of the semester of a company you picked. You're going to want to build a 5-year summary, a 5-year forecast of your company. So pay attention here because this is where the core is of that forecast. What are sales going to be for the next 5 years? Well, how do you figure out what sales are going to be? It's a lot of guesswork, right? And that's okay. So when you're doing a forecast, if you can back up, I think sales are going to grow this much because I think that Apple, if you looked at Apple and you break them into 4 segments, I think that this segment's going to grow this much and this segment's going to grow this much. And you have some idea why. I can't say you're wrong. For sure, because we don't always know that. But you start off making a good, thoughtful guess on where sales are going to be. And then a lot of stuff triggers off of that on your income statement. Now, we also have balance sheets. So we also want to build a balance sheet as well. So again, one thing is you look in the back, and what you do is you can look at percentage of sales. You can take the sales of your last year, what was last year's annual sales, and look at what the balance sheet was. And so what you do is you build a model, a futuristic model, by looking at a past balance sheet. You say, okay, this company had $10 million in cash on their balance sheet, and they had $100 million of sales. Okay, there's a percentage there. So now going forward, as I change my sales in years 1, 2, 3, 4, 5, I can start to build my balance sheet tied to those sales. Does that make sense? So you look in the past again. That's about these ratios and this margin, this idea of tying your balance sheet, current assets, your balance sheet, current liabilities to sales is as good as any, right? It's as good as any because again, companies want to have a certain amount of accounts receivable tied to sales and accounts payable tied to sales. Some things aren't going to change very much. You have debt, you have equity. Those numbers aren't going to really change too much from year to year. So that may be the same from last year. Your long-term assets are probably not going to change that much. You know, you have a certain amount of depreciation every year unless the company's going to do a big build. So little by little, you can build a balance sheet or part of a balance sheet by tying it to sales. So now what we also want to focus on is this idea. If we build an income statement, a traditional income statement is built on GAAP, accounting principles, correct? So with a cash budget, a cash forecast, we don't necessarily care so much about GAAP. A cash budget is internal. No one's reviewing. No one's going to come in and audit you about that. What you really care about is the reality of how much cash is going to go out and how much cash is going to come in. That's the reality of it. We're kind of basing it on the statement of cash flows. So with a cash forecast, generally a part of a corporation that is focusing on this is the treasurer, the controller, right? The folks responsible to make sure there's dough for payroll and everything, right? A company gets in, is in operation for a year or so. The controller realizes that we usually use this much cash during these months. We use more in these months. A lot of treasurers and we'll stick with treasurers and controllers want to have a cushion. I think in the book, they say they always want to have $50,000 on hand, right? Just in case, right? Stuff happens. I want to accommodate my cash needs in cash uses. I want to be practical about over a calendar year what that's going to look like, and I also want to have 50,000. So again, what we want to pay attention to is everything's tied together. So if my sales are a certain amount, that means my let's say the famous term for finance and economics called widgets. I sell widgets, right? And if I say I'm going to sell $1 million of widgets in the first month, I'm going to need to have those widgets produced. That's going to be a cost. Okay, so I got a cost tied to my sales, right? Then I say you have sales, right? And sales don't mean cash, do they? Sales means I booked it and I can feel good that I'm going to get paid. But out of my $1 million of sales in, let's say, January, I may only collect 35% of that. So that means I'm going to put that in as part of my cash part. That means that I'm going to have accounts receivable for the next 2 or 3 months, right? So I'm going backwards and saying, okay, what's the history been of my customers paying me? So I can look at historical reports of your collections, of your area, of your accounting department, or whoever does the collections part, to sort of build a model going forward. Like, okay, $1 million in January, $1.5 million in February. So you're going to have this uneven flow month to month to month, because you're going to always have some cash flow coming in from your sales. And then you're going to have last month's people that didn't pay you in month one are going to pay you in month two. So you're going to have that cash coming in, and you're going to get down to a bottom level. And on the outflows, like I said, you got bills to pay, right? Because in order to generate that $1 million of widgets, $1.5 million in widgets, you need to spend money with your vendors, right? So sometimes maybe you're paying them late, right? Maybe you're paying them in 60 days. Maybe you're trying to tie when you pay them to when your collections are, right? If you're Walmart, you can get away with doing whatever you want to do with that, but not everybody can do that. So again, you're going to build that model. And then and it talks about 3 statements. So be very conscious. In this case, these are 3 statements that aren't necessarily your GAAP 3 statements. Okay. So focus on that. We're in the book. I think the book does a good job in this chapter of walking you through. There is a model you're going to create. And again, you're going to be, you're still responsible for understanding how balance sheets work, right? Because you're doing a plug and play based on your percentage of sales. And the book does talk about some other ways to build this model. Cash is king. At the end of the day, financial analyst needs to understand what kind of cash you're going to be generating. This module, I really do think, is ideally focused for the cash part of a corporation, the controller, for example. Really good thing to understand, so you can see, depending on where you work, your own organizations, how you are tying. You could work in accounts receivable and understand how important your job is to the rest of the organization. And again, it changes. If things aren't working out, maybe you need to change your accounts receivable policies. Maybe you need to collect. Maybe you need to collect later or longer to accommodate your customers. So good luck this week. Let's get everything done on time. Remember that Thursday night deadline for your primary post, and then on Sunday night your second one. Those are important, right? And I just filed a rubric, so see if you can get those in. The earlier everybody gets them in, the more dynamic and the more practical the conversations can be. If everybody's uploading, doing stuff on the last time on Sunday, it's not as natural of a conversation, right? So if you can find some time, spend 10, 15 minutes on your post, make sure you're talking to other people, make sure you give me some citations of some reference stuff above and beyond just the textbook. Okay. So we can give you full credit. Let me know if I can help anybody, and good luck this week.